Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures kicked off the new year with a little bit of strength, but since then we can see that the market has given up much of the gains from the week. And today on Friday, we can see that the market was able to find a bit of support on the 270-degree price level of 376.5. The market is yet to be able to eclipse the previous highs from December that held the market in check for about 2 weeks in December. And currently we sit at a critical zone after the market has posted a number of sequential higher lows. Going into next week, if this market's able to hold this 270-degree mark, it's going to be telltale if the market's going to finally be able to break beyond the previous highs. In doing so next week, we can then look at a potential target of 396, but failure to be able to get above the previous highs from the early in December suggests that the market could very well turn back down again, where we could see a retest of previous lows near 357.5. The decline that we're seeing now for the corn complex coincides with the time factor for Friday, which suggests that the market could turn back up going into next week, but failure to turn back up means that we can break below this key area for the contract itself, and in doing so next week suggests that a big move to the downside could very well be on the horizon. Corn is currently right in the middle of volatility-based support and resistance, and so the direction in which it looks to go right now is still unclear. We need some confirmation of breaking either side of key support or resistance. What we are noticing is that the market is now approached being very close to being in an overbought condition, and in doing so, the market could very well be turning over. The last time that the market was in an overbought condition, it held so for quite some time before rolling over, so this could very well be the case of what happens again. The prior time that the market was in an overbought condition, it held that for quite some time again, but the direction in which it broke out after moving down very slightly happened to be to the upside. So for now, without confirmation, we simply want to wait to see what develops over the course of the next couple trading days. The May contract is trading in a similar fashion, with its key level sitting at the point of control level of 386.25. And so this is the area that we'd be looking for potential support and resistance on either side for this contract going into next week. The potential upside for the May contract sits at 400.25, and its downside potential will be somewhere sub 370. For the July contract, one standard deviation below its point of control sits at 393. And so what we'd be looking for here is whether or not the market's able to hold this 393 level. Upside for the July contract, we're looking at the potential of reaching about 404. And then downside, again, we'd be looking for somewhere in the neighborhood of 375 as a downside price objective. Soybean futures is in a very critical position currently. The market gave us 4 consecutive higher lows where the market has continued to creep up. We had a make or break level sitting at 883 for this market, and as you can see, the market came straight down to this level and was able to bounce and then turn back up from there. From this move, we're looking for the potential for the market to regain or at the very least eclipse the previous high of 941. Instead, the market now has found good resistance right up against its volatility-based resistance band on the lower end of the market trading here at 929. The market has since moved down from there, but we have a very critical timing angle that we're looking at. And if the market's able to hold above this timing angle, it could potentially make a run up to the upside. And the way the market failed to eclipse the previous highs suggests for us that the market could very well be on its way to the downside. We're now looking at a potential price objective of about 855 for the March beans contract, and we want to continue to see the way in which it develops next week. We can see that the market currently is in an overbought position on its way down, and so the small recovery that we're seeing on Friday does not hold through the next couple trading days. We anticipate continued downside movement where the market would push down. Resistance for that same soybean contract happened to coincide with our 360-degree mark above, and now we're looking at the potential of support sitting close to 898.25. Upon breaking 898.25, we believe that that would be very good confirmation of downside momentum, suggesting for us that our minimum price objective of 855 would be more plausible. One additional piece of information was that our 1-by-1 time price factor was very good resistance as the market came up into that level. Its failure to clear this area denotes potential weakness, and again, we'll continue to monitor the way in which the market moves next week. As would be expected, the May contract is giving us a very similar formation, giving us 4 sequential higher lows. The market came up against its time price angle here, and we can see the reversal that happened at our make or break level of 896. We have the same failure to make it above the previous highs of 953, with the market turning down over the last couple of days with a small recovery on Friday. Breaking this natural angle that we're looking at here tells us that the market could very well make its way down, a price objective of about 880 to 881 for the May contract. Taking a quick look at the pertinent levels for the July contract, again, we see the exact same formation occurring where the market reversed at our make or break level of 906 3/4. Here we can see resistance at our volatility-based resistance band overhead, and with the same failure to break previous highs at 964 1/4. We have our time price angle coming in, and this is where we're looking for a key break, potentially for this market if it were to roll back down over the next couple of days, and our downside price objective comes in at 893. The movement in wheat futures continues to be consistent with our projections. The market came in and marginally broke previous lows that sat previously at 503 1/4, and from there the market has been able to edge its way up, crossing the 518 area that we thought was a very critical level, that we believe to be a very critical level for this contract. You can see when the market first made its test that the market simply moved sideways, and in fact on Thursday it looked like it was going to turn back down, only to reverse back up again today on Friday. We're looking at a minimum price objective for this contract sitting at about 538, and the market looks to be on its way up to reaching that target. It is yet to reach its overbought condition as far as the stochastic is concerned, and so the movement that we're seeing right now is very consistent with the movement that we saw previously when the market moved out of being oversold to being overbought. This is where it touched on its previous low, and the market made a nice steady progression on its way up. You can see where the initial correction occurred, suggesting that the market could turn down, and we're seeing a very similar pattern here where the market's made a nice correction, and with another nice big explosion to the upside. Continued movement over the next couple of trading days suggests that it is plausible that we can reach our minimum price objective of 538. Of particular importance for this March contract is its ability to cross its point of control level of 523 3/4. The market is testing this area here late on Friday, and if it's able to close above, making it up to that 360-degree mark looks to be the next key level for this market to transition into, being able to retest previous highs. In fact, if it's able to close above this 530 number early in the week, we would not be surprised to see a movement that makes its way up to about 550. As would be expected, the levels for the May contract are going to look similar, with an upside potential of 542 3/4. And upon breaking through that area, we could very well see the market make its way up to test the bottom end of volatility-based resistance. The key area that we'd be looking for at this time is where the new band may develop, and that's right at about 554.5. The point of control for the July contract sits at 539 3/4, and upon being able to clear that area, we think a minimum price objective for the July contract would sit at about 556 1/4 to about 560. Like the prior contracts, it is yet to reach being in an overbought condition, and so we like the movement that we're seeing, especially with the reversal that occurred today on Friday. In closing, we'll take a look at crude oil futures. The market finally made a significant low late in the year and has been able to edge its way up to key resistance at 53.42. That 53.42 number also happens to coincide with our point of control level of 53.80. And as we can see on Friday, the market has made a very big downside reversal. What we would be looking for as far as the crude oil complex is concerned is to whether or not this market's able to make a higher low and turn back up again, or it's simply going to reverse back down. As would be expected, the market is currently now in an overbought condition and is giving up potentially some profit taking. And so the market now, if it were to make a reversal or come back down and hold support at our volatility-based support area of 48, that could be an indication for potential uptrend that could be developing after this market has been markedly down over the last 2 to 3 months. And finding support near 48 or 49 and then giving us a show of potential strength could very well be a potential buy opportunity where we would put our stops just below this volatility-based support area in anticipation of the market making a run. So it's going to be key to see the way in which this market responds. if this upcoming correction that we're seeing today is going to last, and how shallow it may be in giving us a potential reversal to the upside. Thank you for joining us for our regular market update. Look forward to touching base with you again next time.